The stock market is like a big marketplace where people buy and sell ownership in companies through stocks. Companies use it to raise money, and investors use it to make money. Most trading happens on major exchanges like the New York Stock Exchange, but there are also riskier over-the-counter stocks. Players include investment banks, stockbrokers, and analysts. Investing takes patience, diversification, and a long-term mindset. You can even try a stock market simulator before diving in for real. Welcome to Everyday Elevate, your go-to destination for all things stock market. If you've ever been curious about how the stock market works or wanted to explore the world of investing, you're in the right place. Hit that subscribe button and let's elevate together every single day. What exactly is the stock market? The term stock market denotes the public platforms established for the issuance, purchase, and sale of stocks, whether traded on a recognized stock exchange or over the counter. Stocks, often referred to as equities, represent partial ownership stakes in companies, thereby offering investors a means to buy and sell ownership shares in these investable assets. The significance of a well-operating stock market cannot be overstated in the realm of economic progress, as it furnishes companies with expedited access to capital from the public, thereby fueling growth and innovation. The stock market plays a vital role by fulfilling two key objectives. Firstly, it serves as a platform for companies to raise capital required for various business activities, such as expansion and innovation. For instance, if a company decides to issue 1 million shares of stock at $10 per share, it generates $10 million in capital. This influx of funds enables the company to pursue growth opportunities without resorting to borrowing, thereby steering clear of debt obligations and associated interest expenses. Another crucial role of the stock market is to provide investors with the opportunity to partake in the earnings of publicly traded companies. Investors can reap profits from stock ownership through two main avenues. Firstly, some stocks offer regular dividends, which are a fixed amount of money paid per share of stock owned. Alternatively, investors can profit by selling their stock at a higher price than their purchase price. For instance, if someone buys shares of a company's stock at $10 each, and the stock price later climbs to $15 per share, they can sell their shares at a profit, realizing a 50% return on their initial investment. The majority of stocks change hands on renowned exchanges like the New York Stock Exchange, NYSE, or NASDAQ. These exchanges act as bustling marketplaces where investors come together to trade stocks. Regulated by governmental bodies like the Securities and Exchange Commission, SEC, these exchanges ensure fair play, guarding investors against fraud while maintaining the smooth operation of the market. While most stocks find their home on exchanges, there's another arena called over-the-counter, OTC, where some stocks take center stage. In this realm, buyers and sellers engage directly through a dealer known as a market maker, who specializes in handling these stocks. OTC stocks are those that don't meet the criteria, like minimum price, needed for exchange listing. OTC stocks operate under different rules compared to those listed on exchanges. This means investors might find it trickier to gather trustworthy information about these companies. OTC stocks also tend to have lower trading volumes, leading to wider bid-ask spreads. On the flip side, exchange-traded stocks boast higher liquidity and tighter bid-ask spreads, making them more attractive to investors. Several key players are involved in stock market trading. Firstly, investment banks play a crucial role in handling initial public offerings, IPOs. When a company decides to go public by offering shares, it typically approaches an investment bank to act as the underwriter for the IPO. Here's how it works. The investment bank conducts thorough research on the company's overall value and determines the percentage of ownership the company wants to offer through stock shares. Then it manages the initial issuing of shares in the market, ensuring that the company receives a predetermined minimum price per share. This process aligns with the investment bank's interests, as it aims to sell all shares at the highest possible price. Shares offered in IPOs are typically snapped up by major institutional investors like pension funds or mutual fund companies. Once a stock is issued in the primary market through an IPO, the bulk of trading moves to what's known as the secondary market, where the majority of day-to-day trading occurs. Stockbrokers play a pivotal role in this secondary market, acting as intermediaries who execute buy and sell orders on behalf of their clients. who can range from large institutions to individual retail investors. Equity research analysts are another important group in the stock market ecosystem. They work for various financial entities like stock brokerage firms, mutual fund companies, hedge funds, or investment banks. These analysts delve deep into publicly traded companies, analyzing their performance and attempting to forecast whether their stock prices will rise or fall. Meanwhile, fund managers or portfolio managers, including those overseeing hedge funds, mutual funds, and exchange-traded funds, ETFs, wield significant influence in the stock market. Their decisions to buy or sell large quantities of stocks can substantially impact market dynamics. The stock market's overall performance is typically gauged through various stock market indexes, which serve as benchmarks for assessing how stocks are faring overall. These indexes consist of a carefully selected group of stocks aimed at representing the broader market trends. Furthermore, these stock market indexes are actively traded themselves, often in the form of options and futures contracts, which are available on regulated exchanges. Among the notable stock market indexes are the Dow Jones Industrial Average, DJIA, the Standard & Poor's 500 Index, S&P 500, the Financial Times Stock Exchange 100 Index, FTSE 100, the Nikkei 225 Index, the Nasdaq Composite Index, and the Hang Seng Index. Stock market analysts and investors often consider various factors to gauge where a stock might be headed in terms of price. Let's dive into some key indicators commonly used in stock analysis. First up, we have market capitalization, also known as market cap. This figure represents the total value of all outstanding shares of a stock. Generally, a higher market capitalization suggests that a company is more established and financially robust. Publicly traded companies are obligated by exchange regulatory bodies to regularly disclose their earnings reports. These reports, issued on a quarterly and annual basis, are closely scrutinized by market analysts as they offer valuable insights into the company's performance. One crucial metric analyzed from these reports is the company's earnings per share, EPS, which essentially represents the company's profits divided among all its outstanding shares of stock. Furthermore, analysts and investors often delve into various financial ratios to assess a company's financial health, profitability, and potential for growth. Let's explore some of the key financial ratios frequently considered by investors and analysts. Price-to-earnings ratio. The price-to-earnings (PE) ratio compares a company's stock price to its earnings per share, EPS. A higher PE ratio suggests that investors are willing to pay more for each share of the company's stock, anticipating future growth and a rise in stock price. Debt-to-equity ratio. This metric is essential for assessing a company's financial stability, revealing the proportion of its operations funded by debt versus equity investors. A lower debt-to-equity ratio, signifying greater reliance on equity funding, is generally more favorable. Return on equity. The return on equity (ROE) ratio is widely regarded as a reliable gauge of a company's growth potential, illustrating its net income in relation to the total equity investment. Profit margin. Investors have various profit margin ratios to assess, such as operating profit margin and net profit margin. The benefit of examining profit margin, rather than solely focusing on the dollar profit, lies in its ability to reveal the company's percentage profitability. For instance, a company reporting a $2 million profit might seem impressive, but if it only equates to a 3% profit margin, any substantial revenue decline could jeopardize its profitability. In the realm of stock market strategies, analysts and investors navigate through a myriad of approaches, yet at their core, they frequently gravitate towards two fundamental methodologies: value investing and growth investing. Each strategy offers a distinct perspective on the market and emphasizes different aspects of stock selection. Value investors, for instance, tend to favor companies with a track record of stability and profitability over an extended period. These companies often exhibit strong fundamentals and may offer consistent dividend income, making them appealing options for investors seeking a more conservative approach. However, value investing isn't solely about identifying stable companies. It's also about uncovering stocks that are trading below their intrinsic value. By identifying undervalued stocks, value investors aim to capitalize on potential price appreciation as the market corrects its valuation. Conversely, growth investors are drawn to companies with significant potential for expansion and capital appreciation. These companies often operate in dynamic industries and demonstrate above-average growth rates in revenue and earnings. While growth investing entails more risk compared to value investing, it also offers the possibility of higher returns. Growth investors typically prioritize future prospects over current valuation metrics, betting on the company's ability to sustain rapid growth and outperform the broader market over the long term. In essence, value and growth investing represent two distinct philosophies within the realm of stock market investing, each with its own set of principles and objectives. By understanding these approaches, investors can tailor their investment strategies to align with their financial goals and risk tolerance levels. To embark on your investment journey, start by selecting the right investment avenues that align with your financial goals and risk tolerance. For beginners, it's advisable to avoid individual stocks and instead opt for diversified portfolios to mitigate risk. Diversification involves spreading your investments across different asset classes and sectors. Additionally, brace yourself for market fluctuations and downturns by maintaining a long-term perspective and staying committed to your investment strategy. Before committing real money, consider practicing with a stock market simulator to gain experience and confidence. Remember to start investing now and avoid short-term trading strategies, focusing instead on consistent long-term investment habits for financial growth and security. So, to recap, the stock market functions like a vast marketplace where individuals trade ownership in companies through stocks. Companies utilize it as a means to generate capital, while investors leverage it for potential financial gains. Whether transactions occur on prominent exchanges, such as the New York Stock Exchange, or involve riskier over-the-counter stocks, the market accommodates various avenues for investment. Among its participants are investment banks, stockbrokers, and analysts, each playing a distinct role in shaping market dynamics. However, achieving success in investing demands qualities like patience, diversification, and a focus on long-term objectives. For those new to the world of investing, experimenting with a stock market simulator can provide valuable experience without actual financial risk. So, are you prepared to embark on your journey into the dynamic realm of investing? Remember, informed decisions are key to unlocking the potential for financial growth and security. Ready to elevate your understanding of the stock market and investing? Join us on Everyday Elevate, your ultimate destination for insightful content and practical tips. Hit that subscribe button and turn on notifications to stay updated with our daily uploads. Let's elevate together every single day. Subscribe now and empower yourself with the knowledge to thrive in the world of finance.